Welcome to this video where we'll explore how to start investing from scratch. If you've always thought about putting your money to work smarter or want to learn how to build a solid financial future, this is the perfect place for you. Today, we're going to talk about the basic principles you need to know to get started in the world of investing successfully. The first key point to understand is that money, if you leave it in a bank account doing nothing, loses value over time due to inflation. Even if the number in your account remains the same, its purchasing power decreases every day. This is why simply saving is not enough. Money should work for you, and that's only achieved by investing it. Imagine playing a game of Monopoly without buying properties. Even if you keep accumulating money by going around the board, if you don't invest in assets that generate income, you will end up losing. In the real world, it works the same way. Investing is not just an option, it's necessary to maintain and grow your wealth. Investing is putting your money into assets that generate returns over time. For example, buying a car is not an investment because it depreciates. But if you buy a car to work as a taxi driver or delivery person, then it is an investment because it generates income for you. Assets can be many types: real estate, company stocks, government bonds, among others. The important thing is to understand that you will not always see immediate profits in the form of cash. Increasing your assets, like when you buy a property and your tenant pays the mortgage for you, is also a form of investing. Part 4. Define your financial goals. It is essential that you have clear goals before investing. What are you looking for? Increase your long-term savings, generate extra income in the short term, or reinvest in your own business. Without a clear goal, you run the risk of investing aimlessly and making impulsive decisions. Each investment must be aligned with your objectives and with the level of risk that you feel comfortable tolerating. If you have a business, you could decide to reinvest in it, but if you are looking for more stability, you may prefer to diversify your investments in less volatile assets. Part 5. Know your financial situation and your risk tolerance. Before you start investing, you need to analyze your current financial situation. Do you have debts? Is your income stable? How much money can you afford to invest without compromising your financial security? If you are not clear on this, you could end up in a more difficult financial situation. Your risk tolerance is also key. If you can't sleep peacefully knowing that your investments can lose value quickly, maybe you should opt for safer investments. Part 6. Investment time horizon. Another important concept is the time horizon. You have to ask yourself, do I want to make money fast, or am I willing to wait for the long term? Long-term investments, such as stocks or real estate, tend to be less risky, while the short term usually involves more volatility. Define whether you prefer to hold your assets for years or prefer to make quick moves in the market. Part 7. Understanding the time value of money and compound interest. Money does not have the same value today as it will in the future. Remember that time is an essential factor in investments. Investing now might make more sense than waiting to do it in the future. Also, one of the most powerful concepts in finance is compound interest. This refers to your earnings being reinvested and generating more earnings, which creates a snowball effect. The sooner you start investing, the more you will benefit from the power of compound interest over time. Part 8. Types of investment. Now that you understand the basic principles, let's look at the types of investments you can make. 1. Stocks. Buying stocks makes you an owner of a part of a company. Some companies pay dividends, a portion of their profits, which gives you periodic income. 2. Bonds. These are loans that you make to entities such as governments or corporations, which return the money to you with interest. They are safe investments, but with low returns. 3. Investment funds. These pool money from several investors to buy a variety of assets. They are managed by experts and offer you diversification in a simple way. 4. Real estate. Buying properties to rent or resell is a solid investment. Although it requires more upfront capital, it can offer long-term stability. 5. Cryptocurrencies. Digital assets like Bitcoin and Ethereum are known for their high volatility. If you decide to invest in cryptos, you must be aware of the high risk they represent. Part 9. Portfolio strategy and management. Creating a financial plan is essential. Diversifying is key to reducing risks. For example, you can allocate a percentage of your income to different types of assets like properties, stocks, or cryptocurrencies. Additionally, you should review your portfolio regularly and rebalance it based on market changes or your own goals. If one asset has become too dominant in your portfolio, it might be time to sell some of it and distribute your investments more evenly. Conclusion. If you liked the video, give it a thumbs up and subscribe to the channel. Investing is not a decision to be taken lightly. It's about being informed, being patient, and planning for the long term. With these basic concepts, you are one step closer to making smart financial decisions. Remember, the goal is to make money work for you, not the other way around. I hope this video has been helpful and inspires you to take the first steps into the world of investing.